US stocks continued their volatile pattern, with the three major indexes closing mixed and showing a slight downward trend overall. The market sentiment recovery effect brought by eased global economic uncertainty gradually faded, and the sharp dive in oil prices triggered a pullback in the energy sector. Capital oscillated between growth and defensive sectors. Trading activity declined compared with the previous trading day, and market caution heated up again. Next, at the close on March 10th Eastern Time, the Dow Jones Industrial Average fell 34.29 points, or 0.07%, to 47,706.51. The Nasdaq Composite gained 1.15 points, or 0.01%, to 22,697.10. The S&P 500 lost 14.51 points, or 0.21%, to 6,781.48. The three major indexes consolidated with fluctuations after opening, with fierce long-short competition during the session. The Dow and S&P 500 closed slightly lower, while the Nasdaq barely closed positive, and the overall fluctuation range narrowed significantly compared with the previous trading day. Sectors showed significant divergence with increased internal differentiation in the technology sector. Memory chip and optical communication concepts performed strongly, while the energy sector pulled back sharply. Memory chip concept stocks rose collectively, with Micron Technology and Western Digital up more than 4% and SanDisk up about 3%, benefiting from the expectation of full-year memory chip price increases. Optical communication concepts performed prominently, with AAOI up more than 10%, Lumentum up more than 9%, and Corning up more than 4%. The energy sector was dragged down by the plunge in oil prices, with ConocoPhillips and ExxonMobil down more than 1%. Bank stocks rebounded collectively, with Citigroup up more than 3%, and Morgan Stanley and others following suit. Most Chinese concept stocks strengthened, with NIO up more than 10%, Tencent ADR up more than 6%, Jinko Solar up more than 6%, and the Nasdaq Golden Dragon China Index rose in tandem. On the macro front, signals of eased global economic uncertainty continued to be released, but the market still had concerns about subsequent developments, and capital safe haven sentiment did not fully subside. The sharp plunge in oil prices eased inflation concerns. U.S. bond yields fluctuated slightly, and the market's judgment on the Federal Reserve's policy path remained cautious. News such as expectations of memory, chip price increases, and Tencent's AI agent research and development drove related sectors to strengthen, while the energy sector came under pressure due to the pullback in oil prices. The overall market lacked a clear main line and presented a structural game pattern. Commodity markets showed obvious divergence, with energy and precious metals showing a deviated trend. International crude oil prices plunged sharply, with WTI crude and Brent crude down more than 7%. The previous geopolitical risk premium faded rapidly, coupled with the expectation that the G7 would jointly release oil reserves, pushing oil prices down sharply. Precious metal prices fluctuated and strengthened, with spot gold touching $5,200 per ounce, New York Gold continuous futures up more than 2%, and spot silver up more than 2% intraday. Safe haven demand and inflation hedging demand jointly supported the precious metals market. The US dollar index fluctuated slightly. Non-US currencies fluctuated in a narrow range, and the market focus turned to oil price trends and the subsequent evolution of geopolitical situation. Looking ahead, US stocks will remain in a volatile consolidation pattern in the short term, and the sector divergence may continue to intensify. The memory chip and optical communication directions in the technology sector are expected to maintain strength. The energy sector may show volatile performance affected by oil price fluctuations, and precious metals still have certain allocation value. Operationally, It is recommended to remain cautious, focus on structural opportunities, pay attention to strong sectors such as memory chips and Chinese concept technology, and at the same time, closely track oil price trends and geopolitical developments, strictly control positions, and flexibly respond to short-term market fluctuations.